Welcome to Facts Pro, where it's all about facts, financial, accounting, and tax strategies. Today, we continue with our series talking about some advanced tax strategies that when we feel that we exhausted all the basic strategies, we've already done everything possible and everything that's out there in the social media and in the ebooks and all of that, then we can explore other options that are available and that are tax like very efficient tax from a tax perspective. All right, so what I'm talking about today is another sort of investment that can actually bring you back your money in year one. Like if you put in, and we're gonna see some like real examples of people who put in an investment in year one and they got it back in tax saving. I'm not saying that they got it back as the return on investment. They got return on investment from their tax savings that are available to them. And I'm talking about solar project investment as our tax strategy for the day. All right, so let's dive in and I'll share my screen with you to know what I'm talking about. And as you know, I like to start with a joke, and the joke is about the sun, since we're talking about the solar. All right, so again, what are we talking about today? Solar project is a smart tax strategy for high earners, for those who have they earn high income and they're having the problem of paying too much taxes. More than 50% goes to the IRS and the state. If they live in a state that has income tax, then they pay about 50% or even 40% to in taxes, and they're having a problem with that because they want to get more of their income back into their pockets. So the IRS dollars that go to the IRS, we want to turn that into renewable energy investment. How and what are the logistics of that? This is what we're talking about today. All right, so again, definitely there is a surge in the renewable energy because, as you know, that the solar adoption is booming, and from not only homes and businesses, but also we do it as investors. And the good news that under OBA, the new law that was enacted on July 4th of this year, the incentives from the Inflation Reduction Act related to the energy credits, they're extended until 2027. So you have till the end of this year, you have next year to do more of investments in solar projects and get the benefits. And definitely it's something that's appealing both socially and financially, and we'll see why and how. So why high earners are paying attention to this as a tax strategy? Because solar project can increase your take-home income by 50%, and it's applied broadly. Like you can offset your salary, you can offset your bonus, restricted stock units, all your business profits, capital gain. You can offset your income with these losses coming from that investment. And that would help not only losses, not like tax write-offs, but also tax credits that can help you get tax savings. We're gonna see how. All right, so there are three major benefits of solar project. First of all, we said that there is investment tax credit. And if you don't know the difference, again, tax credit is like a dollar for dollar tax saving. If you have $1,000 tax liability, if you have 400 in tax credit, you get to pay only 600. But when it comes to deductions, you have to multiply the deductions by your tax bracket in order to get to the saving. So we're talking about investment tax credit that's a dollar for dollar. You don't have to multiply that by your tax bracket. Depreciation gets as you treat it as a deduction and you multiply it by your tax bracket, which I'm talking to the high earners who are at like the 37% tax bracket or so. And in this case, you get accelerated depreciation, accelerated deduction. In addition to that, we're not only talking taxes. If you know me well, I'm not only talking tax savings, I'm also talking wealth building. So it generates you some income stream for like 20, 30 years of cash flow, about 1 to 5% of what you put in annually. So it also generates some cash flow and income stream for you. All right. So there are three popular solar structures. There is a flip partnership, which is ideal to maximize your upfront tax benefit. There is the sale leasebacks, where it provides you with a stable cash flow and lighter tax offset. And you can buy the project, like you can you buy or you purchase the asset. We have full ownership, full tax and cash benefit. So with flip partnership, you partner with the developer. So there is a developer and there is a buyer. You're the buyer, you provide the capital, and the developer manage the project. For the first 5, 6 years, you're like a major owner, so you get 99% of the tax credit and depreciation, they all go to you. After the flip, after the 5, 6 years, it flips. So the developer get the majority ownership and you become minor with the cash flow. So what is the benefit of this and who's it suitable for? It is best for those who earn more than 500K and they need some big upfront offset for their either W-2 or a business income. All right, so that's the first one. Second one is a sale lease back, and that provides stable cash flow and it provides lighter tax offset, but it still depends on your goals and your needs. So in this case, the developers sell the project to you and then they lease it back. So you get the tax credit, you get the depreciation, and you get a steady lease income. And the developer, they handle the operations and the maintenance. So it's good for predictable income with moderate tax benefit. It doesn't provide you the same high tax credits as the first option. Last one is when you buy the assets. You have full ownership. You buy the solar project outright. There is 100% ownership. And you definitely, in this case, you claim all the tax credit, you claim all the depreciation, and you keep 100% of the income from the energy production. But definitely, in this case, you take care of all the maintenance and the operations. So it's best for those who want control and they need long-term cash flow. So yeah, I wanted to do the solar, which solar structure is best for you. And this is more of like comparison between the three. So the tax benefit, the cash flow, the control, and who's it gonna be best for? So in the flip partnership, again, maximum upfront tax saving, you get the credit depreciation in the first 5, 6 years. It provides you with cash flow later, but it's going to be smaller because now you're a minority owner. So the control is shared with the developer. And again, it's best for the high earners, those who need large offset, like more than 500, they earn more than 500K. Sale leaseback, it's for moderate tax benefit because it provides you still with credit and depreciation, but it also provides you with cash flow, stable lease payments, and the developer usually handle the operations and management. And it's best for those who want predictable income and lighter tax write-off, like tax savings or tax write-off. They don't have that pain of paying too much in taxes. They want some write-off, but not crazy. Asset purchase, this is full tax benefit because you get 100% of the tax credit and depreciation, and you get 100% of the income stream. You get full ownership and liability, but you also seek, and it's best for those who seek long-term control and cash flow. I'd like to go back to the real life example of Catherine. Catherine had an income of $3 million. So her tax bill was about 1.5 million. She decided to invest in a flip partnership solar investment and put in 600K there. 600K generated her 858 tax savings in year one. Do you understand what that means? You put in 600K, you brought in tax savings of higher than 600K. You already got your investment back in tax savings. And instead of paying the 1.5, you'll pay 1.5 minus the 858. Where did this come from? It was 472 in tax credits, dollar for dollar. Plus, she had depreciation. So depreciation with at this 37% tax bracket, it brought her 351 in federal tax savings. And from the state, assuming 13% tax bracket, she got 158,000, not 158, 158,000. So at the very least, if she didn't do anything, if she didn't put in this 600K, what would have been the situation? She would have lost at the difference. She would have lost the savings. She would have lost 200K, and that's if she hadn't done anything, and that's not even assuming the cash flow and the savings from next year. Is not only year one. We're talking here about year one, but also future years bring you more tax savings. So here, when we calculated the net gain versus doing nothing, she earned about 414 when she invested in this. And again, just as simple as this, if you forget about the 414, how we got to it, you just looking at these numbers, if would she have paid the 1.5, or she would have got the 1.5 minus the 858 plus the 600. So at least the difference here, the 258K, would have been a great savings for her. All right, so just there are some rules that we have to know. The IRS require you to have material participation requirement, which is 100 plus hours a year. So unfortunately, they're very vague about what constitutes this 100 hours a year. So you need to treat it like if you have a business. So it requires active participation. You would be an owner of LLC. You handle it as if it's a real business, regular activity. But if you don't have the time, you have a full-time job, you have your business to worry about, then we're gonna consider this if it's a good fit for you from a passive perspective. If you have passive income that you want to offset with some passive losses. Definitely documentation and tracking are essential to be in compliance. There are some risks, definitely, and consideration that you have to put in mind. First of all, that you have to be selective of what projects you invest in, because projects must be placed in service in the year you buy it. You must stay operational at least 5 years to avoid recapture of credit. So you have to bear that in mind. The developer reliability is very critical in this case, so you need to know who you're partnering with. For W-2 depreciation, there is a cap on the depreciation. I mean, for the W-2 employees, the depreciation is capped at 313 for single, 626 for couples, or for married filing jointly. But you can carry it forward. So it's capped for you, but you can carry it forward for future years. Credits are limited to 75% of your tax liability. So again, this is good for people with high tax liability, but if you don't have a big tax liability, you're not benefiting from the credits. And you also can carry forward 15 to 18 years of the unused credit. Okay, so why this matters? Because we want to redirect the tax dollars to build wealth and cash flow. As you saw, if you haven't done anything at all, if you don't invest at all, you're putting a lot of money into the IRS hands, while you can use this money to invest in your own wealth. And definitely it has also an impact on the environment. So you're having a great investment from that perspective. And again, it's better than IRS checks, because if you look at the pre-tax and after-tax investing, it's a great difference. So next step, you have to explore if the solar is a good fit for your tax plan. And as I said before, when we do a tax plan, we don't recommend all these strategies. It depends on your situation, your goals, your risk tolerance. will be recommending if it can fit your tax plan or not. But the key is you have to plan. That's the point. You need to compare the structures, which one would work for you. You need to work with an expert to select the qualified developer and definitely book a free consultation to run your numbers. So don't just pay taxes, redirect them into something that works for you. And here's my contact information to have a free 30-minute consultation to see if this is a good fit or if it can work good for you or maybe not. All right. Thank you so much, everyone, and I'll see you next week.